Okay, here's going to be an introduction to the balance sheet for corporate finance students. So in a sentence, what does the balance sheet tell us? It tells us how a firm finances its assets. So a firm, nothing other than a set of assets. And there's two ways if you want to start a firm, you want to buy and generate assets. You have two choices about how to finance these, debt and equity broadly, right? So this is going to tell us, the balance sheet is what our assets are and then how we finance them. So often you're going to see this. Assets are defined to be liabilities plus stockholders' equity. This is called the balance sheet identity. It is an identity, it's not an equation. Sometimes you'll see it written with an equal sign, which is somewhat incorrect. What the difference between an identity and an equation is, an identity always holds, and an equation, it only holds for a certain set of numbers. So the idea here is, because equity is a residual claimant, they get whatever is left over, then we can plug in any two numbers here, and any two numbers here, we just plug in our stockholders' equities, which makes these two equal. So making this example concrete, this would be an equation, x squared minus 1 is equal to 0. Note, this only holds for x is 1 and negative 1, right? So this is an equation. This is an identity, always holds. I plug in, I have assets, I have liabilities, and stockholders' equity is whatever assets minus liabilities is. Okay, good. So taking a look at the balance sheet, right, tells us how a firm finances assets. This is going to be, particularly important. Another way of saying this is it tells us the firm's capital structure or capital stack, right? Those two terms can be used interchangeably. The text generally says capital structure. I often hear capital stack when out at consulting at companies and so forth. So you can use those two terms interchangeably. So talking a little bit specifically about how the balance sheet is structured. We have assets. They're usually listed in terms of, in descending liquidity. We'll talk a little bit about liquidity. Liquidity is the speed and the ease with which you can turn something into cash without dropping its value. So you remember there's two sections of that. Ease with which you can turn it into cash, that's what students usually say, but also without dropping its value. So we have current assets, we have fixed assets. Example of current assets might be cash, accounts receivable, inventory. Again, these are going to, we're going to turn these into cash in less than a year. The definition of current would be they turn into cash in less than a year. Then we have below that fixed assets. This would be machinery. We could have tangible or intangible. Tangible like machinery, trucks, equipment. Intangible would be like a patent. At least in my course here, I'm not going to make any distinction between the two. So this is an example of what we would have on the balance sheet. An important point that I'll probably reiterate later, but the value of these assets on the balance sheet is at cost, right? So the big, a big thing to keep in your mind when we're in finance and we're looking at a financial statement like a balance sheet is that we care about market value, but what is on the financial statement is book value. So it's whatever I paid for the machinery, right? And I could have made, it's whatever I paid for the land, and I could have paid for it 100 years ago. So the market value could be quite different than the book value. And while I'm here, I might as well mention, keep in mind, specifically talking about the difference between market value and book value, that there are assets that a firm has that aren't even listed here. So, for example, if you're a firm like Goldman, one of your greatest assets is your people, the idea, and the ideas that they can generate, and your reputation, right? That shows up nowhere on here, right? So the market value of the assets, in total, can be quite different than the book value. We expect the market value of the equity to be quite different than the book value of the equity, which would be stockholders' equity. And while I'm here, I'll just mention one more thing before I move on. Keep in mind that this is, again, I mentioned book value of the equity. So if we could have the case where liabilities are greater than assets, in which case the stockholders' equity would be negative, right? So this is different than the market value of equity. The market value of equity takes into account the limited liability. So market value of equity can never be negative because of limited liability. Stockholders are not liable for firm debts, right? So this will never be negative. However, here, it absolutely can be negative. So it's important to keep in mind. I have it over here, the difference between market value and book value. Okay, so we have our assets over here. Liabilities we also list as current, long-term. Examples of current would be accounts payable, any sort of short-term debt that we have to pay in less than a year. Long-term liabilities are debt that we'll have to pay in longer than a year. Not important, but you'll see this term. There's also a term, the difference between the current assets and current liabilities, right? This is net working capital, right? So this would be current assets minus current liabilities. It's not important for a corporate finance course. This is, the idea here is the only place it might be relevant is when we talk about projects. To start a project, you'll need to make an investment in working capital in the beginning because you're going to sell stuff, but it goes into which you have to produce, but it goes into accounts receivable. So the difference between the two is net working capital. If it's important, I'll say more about that some other lecture. Good. So anything else I want to mention about? So the last thing I have here, and this is just kind of like a visual aid. If this is your assets, and the length here is the dollar value, and this is the dollar value of your liabilities, and your equity is just sort of whatever is left over, right? Remember, equity is a residual claimant. You get whatever is left over. One thing I want to mention before I move on, it's just sort of an intuitive way to also look at this, and it's one of the ways that I sort of like to look at this, about equity being a residual claim, is that one way to look at this is assets. Whatever your assets are, they are always claimed by someone. So if you're sitting there at a company and there's a computer, that is either claimed by liabilities or equity holders, right? So the idea is it's either maybe claimed against debt or it's just owned by the equity holder. So another kind of way of looking at this is everything the corporation had, every asset is always claimed by something. There's not any asset that's not claimed by anyone. And again, that comes from the fact that stockholders are a residual claimant. Good. So that's a little bit of overview about the balance sheet. I want to mention that a balance sheet is a snapshot of time. I don't want to forget that. So let me just mention that now. Balance sheet is a snapshot of time. So what we're looking at is we're looking at the capital structure right now. Right? It's not the capital structure over a quarter or over a year. It's just that at the end of the quarter, this is what our balance sheet is right now. And that's an important, particularly, it's not terribly important for this course, but it is very important if you're actually going to start analyzing financial statements to know that the balance sheet is a snapshot in time. To give you an example of why this is important, and you can do a little research on your own, but Lehman Brothers, if you remember the investment bank that failed, they took advantage of that with, I believe their repo was Repo 105. But the idea here is, what they did was, don't worry about what a repo is, but the idea here is, they were going to take the balance sheet as a snapshot at one date. So all they did was they basically got a lot of bad assets off their balance sheet and then put a lot of cash on their balance sheet. They took that snapshot, and then after the snapshot was over, they got rid of the cash and they put the bad assets back on the balance sheet. So that's sort of taking advantage, the unfortunate aspect of it being a snapshot in time. So just keep in mind, it's not an average over a quarter, it's just a snapshot, and that unfortunately can be gamed a little bit. Okay, so we talked about that it's also called a capital structure, capital stack. What the balance sheet will tell us, it tells us how a firm finances its assets, but how they finance their assets is termed financial leverage. And the reason being is the more debt you use, the more we say that you're increasing your leverage. So the more leverage you use, what that means is we're magnifying returns, we're magnifying gains or losses. As a brief example, I've given this in other places, but let's say your assets are going to go up by 1%. You know this. So you can finance them all with equity, in which case your return on equity will be 1%. Or you can finance it 50% debt, 50% equity. So I put up 50% equity, $50 equity, $50 debt. It goes up by 1%. That's a 2% return on equity. The return on the assets was the same, but my return on equity is doubled. Right? So that's why we call it leverage. So more use, the more your liabilities are in your capital structure, the more you're going to magnify gains or losses on your assets. It works both ways. Your assets go down by 1%, then you will lose, a negative 2% return on equity. So that's where, so if somebody says like, what's your capital structure, what's your capital stack, most often they're trying to get what your leverage is, right? The term financial is tacked on here because there's another term for operational leverage, which are fixed versus variable costs. So that's why we just, sometimes people will just say leverage, right? But on the balance sheet, we mean financial leverage. Liquidity, did I talk about whether it's good or bad? So I defined liquidity, how quickly you can turn something into cash without dropping its value. One thing to ask is liquidity good or bad? Liquidity is, you want moderation of liquidity. So the idea is the more liquidity your firm has, the less likely you are to go bankrupt because you can always make your payments. Bankruptcy is you cannot make a payment to debt holders. So some amount of liquidity is good. However, if you have a lot of liquidity, remember, liquidity turns into cash in less than a year, so you're going to earn the return on cash on those assets. So the idea is, if you're holding a lot of liquid assets, they have a very low return. So too much liquidity is bad because it's going to give you a very low return. Stockholders, your investors don't want the return on cash, which is now zero, right? If you make electric cars, your investors want you to take risk, build electric cars and earn a high return, right? They don't want the return on cash. So too much liquidity is bad. Too little liquidity is bad. You want a moderate amount of liquidity. Yeah, and I think I talked a bit about market value. So, in closing, to keep in mind that we're looking at book values here. What we care about are market values. The current stuff might be close to market values, but some of the other stuff is very different. Fixed assets or tend to be more different than their market values. And then there's all those assets that aren't even on the balance sheet. So we care about market values, but we have to use book values when looking at financial statement. Excellent.